Welcome to Power Charting. I'm Bruce Frazier, your host. Today, a discussion about gold and the dollar. We've recorded this on June 3rd, and original broadcast will be on June 7th, so a few days away. But we've added extra preservatives to this presentation so that we could extend the freshness dating on this broadcast. So we are seeing some things in the gold market and also with the dollar that are quite interesting and potentially could light the way about what's ahead for both of these very important indexes as we go through time. So let's get started. Today's agenda: the dollar, is it overbought? And is the gold futures on a pivot, an important pivot for an important move? Dollar and gold generally are non-correlated or inversely correlated assets. So is there something that we can tell from comparing them to each other? And does this tell us whether or not there's change in the wind ahead? Okay, here is a very long-term chart of gold. And so from this, and you've seen this chart before, I'm sure, because we've talked about it repeatedly, you can see that there's a very important upward stride here in the gold market that has carried all the way up into a buying climax in 2011. And upon that climax, where there was a throw over of the trend channel and then an important test, we had a critical decline that resulted in a selling climax in 2013 and produced a range-bound market for gold. Now, what's important about this is thereafter we can see that there's an important downtrending trend channel that has been in place from 2011 all the way to the present in 2019. And that here, look at where we are. Such an interesting place, because we are right on the overhead supply line, which its purpose is to hold back the market and keep it in the downtrend. Well, right now, gold futures are knocking on the door of that supply line. And remember, these are monthly bars. And so the most recent month is June, which we are in the beginning of. And in June, we have gold trying to eke its way above that very long-term important downtrending trend line. So this is a really interesting place, and we're going to zoom in and look at this area more closely. So we had a major uptrend and a buying climax. A possible accumulation is forming after a long bear market. 5 years since the selling climax, could be actually closer to 6 now. 2 higher lows since the shakeout, labeled the last point of support. Here it is right here. We wrote a blog right when it went down and touched this support line. And then we have a last point of support, which is on August 18th, which is where we drew that, wrote that blog. And then also we have a major sign of strength rally, which we are looking for and is needed to be able to demonstrate that this market is in a position where it wants to go up. So that would take us up to the area of this red resistance line right here. And so that would give us that sign of strength that would take us above these highs that were made back in early 2018. So this is the thing that we will be looking for to demonstrate that we have an important change of trend here. Keep in mind, people are, I think, generally very bearish on gold. And we'll talk about more about that in a minute. But notice that the shakeout came at the lows in late 2015, right at the end of the year. You can see important lows tend to come right as we approach the end of the years, right here, pointing them out. And then notice what happened. We didn't have a low at the end of 2018. It actually came in August, and we've been at a much higher, we actually were at a high at this downtrending line at the end of 2018. And an important thing has happened since, and that is that we've had a drifting down, but very shallow decline compared to the ones that preceded it. So big decline here in 2016, 2017, big decline here in 2018, and currently this decline, an important decline of some number of months off of this trend line, is really very shallow and very mild. And so that is an important and interesting condition. Okay, so now let's move on and have a look at the dollar. Here's a long-term view of the dollar. Now, we were looking at monthly bars on gold. Here we're looking at weekly bars on the UUP, which is our surrogate for the US dollar index. And interestingly, we have a very sharp uptrend that has taken place into 2014, first quarter of 2015, into a dramatic climactic move. And it would be hard to find a climax that's more dramatic than this. Automatic reaction followed the buying climax, set a range-bound condition with a resistance line at the buying climax, support line at the automatic reaction, and thereafter it produced a range-bound condition. Notice how this range-bound condition has pretty well held all the way through. And so the support area was breached slightly in 2016. Thereafter, a very stiff rally up into an up thrust right here, and then a long protracted decline that went down into a major sign of weakness in 2018. Now, what's followed has been a very good rally that has gone right back up to resistance. And so the big question becomes, is this resistance area an important overbought condition that is going to end the advance in the dollar? Well, let's have a bit of a discussion about that, because there's some interesting things going on right now. Often a strong dollar coincides with a strong domestic economy. And that is exactly what we've had in 2018 and into 2019, is that we've had a strong economy, both domestically and internationally. We have been the economy that has been really admired the world over for our domestic leadership in terms of GDP. So here we have a condition where the dollar is going up and up and up. But notice something interesting that's happened. The first part of the leg up was sharp, steep, and then had an important pause, an important reaction. Thereafter, the uptrend continued. So we have a nice uptrend that has been relatively persistent. I'm going to draw this so that you can see what I mean, and then I'll erase it. But you can see here that the advance has become narrower and narrower. Now, for you Ellioticians out there, Elliott wave would look at this as a diagonal fifth wave. And what we see here is, in a diagonal fifth wave, is we see a resistance line that is running at a rate. In this case, you can see that it's running upwards to the resistance area on this overbought line. And then the demand line underneath is running up also, but at a steeper rate. So these two trend lines converge. Now, I don't pretend to be an expert on Elliott wave, but this is a phenomenon that's seen in markets and has been for a very long time. And so one of the conditions of a diagonal triangle like this is a diagonal fifth wave, you might call it, is that if it fails, it can fail quite dramatically, where you can have a decline out of the rising trend channel, which is converging, and have it fall very quickly down to an important support line, which would be this one right here, I do believe. This is something that we see often. Now, there's many cases where we have constricting triangles like this, or diagonal waves, which resolve themselves up and out into a new uptrend, and that certainly is possible here. So we want to talk about the conditions under which we could have a bout of weakness in the dollar and what that might mean for the gold market and potentially for the stock market. So we can see here that we have this constricting triangle. Now, my theory here is, and we see this a lot in Wyckoff, is that you often have distribution that will occur not on a horizontal scale as we normally think of it, but will happen on a rising scale. Stock or an index being sold on a scale up. And this is an important idea. It's kind of a nuance, but what I want to do is I want to show you an example with the dollar of this, so that you can think about how we might have large informed interests like the composite operator using a rising trend to raise cash, sell stock, reduce their positions because they are using the strength of the market to be able to liquidate some or all of their holdings. Now, over here would be an example of a distribution that's occurring on a horizontal basis. And here is an example, potentially, we don't know yet, of distribution occurring on a scale up. So let's have a discussion about this. Here is a daily chart close-up of the area that we just looked at on the weekly of the UUP. And you can see here with more detail the diagonal triangle formation where these two trend lines, the overbought line over the market and the demand line under it, are converging upon each other. And so this, we are contending, is a distribution on a rising scale. You can see that this is classic Wyckoff trendline construction, where we are drawing on the red boxes the overbought line, and with where the blue boxes are, we're drawing the demand line. So now, what's unusual about this look is that I have labeled the distribution characteristics on a market that is rising, which seems counterintuitive, but this is how the composite operator often wants to be able to raise cash, is on and sell stock, is on strength in a rising condition. So here we can see preliminary supply, buying climax, and thereafter an important reaction, which we're calling the automatic reaction. Buying climax creates resistance, automatic reaction creates support. We can see they're on a rising scale, and here after the automatic reaction and the secondary test, we see a large volatile trading range, which is classic phase B type behavior and distribution. And then notice the upward movement here, which has a accelerating quality to it and produces an upthrust. And so this upthrust then is followed by an important reaction. It does not get all the way back to the demand line. It continues to have a rising scale. It just, this market is rising faster and faster on the support areas. And there's a throw over here again, and we're calling this the last point of supply. Remember, everything's on an upward scale. And so here we have a last point of supply, a test which occurs right here, and now notice something that's happening. Look at the reaction that has occurred off of this test of the last point of supply. And that test has been accompanied by large amounts of volume, which is evidence. There's two things here that are evidence of distribution being in an advanced state, and that is that we have 2 days here with widespread and we have high volume. And so spread and volume coming together is evidence of a commitment to a direction in the market. And we are seeing that here. So I am suggesting that if the dollar is truly turning off of a diagonal exhaustion condition where this entire run up to the resistance area on that larger weekly chart is a overbought condition, a test, and then a failure, what should happen is this, is that we should see the dollar, the UUP, break this uptrending demand line and should break that pretty handily. Maybe it spends a little bit of time bouncing around in this area after breaking it, but a true completed distribution will have a sudden and sharp decline to an important support point below. And so this is something that we would be on the alert for. This is an advanced condition of distribution. After a last point of supply is when you see the markdown typically begin in earnest. And so what could happen next from here is that we would expect to see a decline that would go to the important support zone, and that support zone is this line that we've drawn right here, and that is at the point of the automatic reaction. And so we could see a sharp sudden decline that could go very quickly all the way down to this support zone and turn the trend of the dollar and turn it suddenly. And so that would tell us and again, the indications are expanding spread, rising volume, increased volatility, a break of the important demand line, and then an inability to be able to initiate a bounce rally back up, but maybe the market just goes sideways or just suddenly just starts to liquidate, goes right down to that support area. Okay, so now here's the other thing I want to talk about is the gold futures contract in relation to the dollar. And so let's get into that. Here is the UUP dollar index and gold continuous contract futures on the same chart, so that we can see a relationship that you already, I'm sure, are familiar with. And that is that gold and the dollar tend to be inversely correlated to each other. And so let me show you an example. And so in the case of this most spectacular rally in the dollar back in 2014, 2015, during that time, gold was generally in a declining trend. As we would expect, gold is dropping as the dollar's becoming more and more valuable against other world currencies. So this is a inverse correlation. Often gold and the dollar can be non-correlated, but more often than not, you can find that there is an inverse relationship. All other things being equal, when the dollar becomes more valuable, gold doesn't have to change in value around the world to become less valuable against the dollar. So the dollar becomes more valuable, gold becomes less valuable in dollar terms. And so when you see a chart of gold here, for instance, this chart, it really is the dollar priced, or the gold priced in dollars. And so that is part of the nature of the inverse correlation. Now, let's look here. You can see that this decline right here is correlated to a rally in gold. So decline in the dollar, rally in gold. Decline in the dollar here, rally in gold. So you can see here inverse correlation. So now, excuse me, you can see here a high price in gold and the dollar is at a low price, oversold, major sign of weakness underneath the support area, turns up in 2018 and has this important rally which we just analyzed here, which has resulted in what we think might be a diagonal triangle. And so we can see that the inverse correlation, oh, but something's happened here. Something is different that might be important for us to know. Because look here, here's an important low in gold and the dollar's rallied. So there's inverse correlation from here to here and from here to here. Let me clean this up. But then all of a sudden, when we get into this diagonal fifth area, right in here, we have the dollar rising and we have gold falling here. But notice what occurred before. Gold's rising, the dollar's rising. So this means that gold is rising faster than the dollar, which indicates that in world terms, now gold is outperforming the dollar. They're both going up together at the same time. This is something that is largely different than anything else that precedes it on this chart back to 2014. So very interesting. Now look at what's happened here most recently. There's a pivot occurring, and this pivot has turned up the gold market in these last 2 weeks. This is a weekly bar chart where the dollar has not really moved. It's right here at this key resistance area, two forms of resistance, the overhead, the overbought line on the diagonal, and also the resistance line, which goes back to the buying climax in 2015. So the dollar remains at a high level and strong, but now all of a sudden gold is pivoting upwards off of a very mild reaction. And so this is a most interesting condition. We can see on this daily chart that we were just looking at that this reaction that's occurred where gold has been drifting downward has been really relatively modest. Nowhere near the volatility of the declines and the advances that preceded it. But notice this, all of a sudden, gold pivots upward. It's come to life. We have 3 really good daily bars here and a turn off of this important test of prior lows. And we have the dollar all of a sudden becoming a little bit weak. And it is not through its lower demand line yet, but it could be quickly if it continues to decline at the rate that it's at now. So this is a really interesting turn of events that might be a very early warning about a change of conditions between the dollar and gold. The dollar may be reacting to the possibility of increased trade war activity, additional tariffs across countries, and so on. Generally, currencies don't like that. They don't perform as well in really any country involved in trade wars. And so it could be that gold becomes an important currency alternative because it's not subject to the trade war issues that are all of a sudden coming to life here. Now, here is a daily chart of gold, and you can see here this green downtrending line is that 7-year downtrend drawn on a daily chart. And notice the attempt to show strength above this overhead supply line, and then a backup. This is the backing up action we just talked about, a test here You can see a rather dramatic pivot where after the backup, it's turned right back up and is attempting to get back to the prior highs. So this is the kind of activity that we would expect to see. Here we have a point and figure chart that we published back on August 28th of this important distribution area, and then also this important accumulation area, which gave us a count up to 1370, 1320. We went to 1350, and then we started that backing up action that we just looked at. And so there's a very large reaccumulation area and also resistance up at 1410 we'd love to get to show that we're that the gold market is strong here. With the very little bit of time that we have left, let's look at 3 stocks in the gold mining industry group that has the potential to be leadership in a turn upward for gold miners if the dollar breaks down through that demand line, trend line in the diagonal pattern that we just evaluated. And so if we start to get weakness from the dollar and we start to get strength from gold, where are some great candidates? Now, this is not by any means an all-inclusive list. These are just some ideas, fit a profile. Let's have a look, see whether or not they might work for us if gold starts to have some leadership qualities. Agnico Eagle. And so you can see here it's turned up. It's above its long-term moving average. It's pulled back. The moving average is now rising on price, and we've got a pivot upward for Agnico as it tries to turn up and get through the overhead resistance that is just above the level that we're at now. Relative strength is all important. You can see here Agnico has pulled back to its rising moving average. The relative strength is starting to turn up. That shows that it's leadership. And so if this leadership can persist, you have a rising relative strength. It's above a rising moving average. This is very hopeful, very quality situation. Here's Agnico to its own peer group. Notice that Agnico has been rising to its own peer group for a period of time now, going back to November and then to February. This looks terrific. And so we can expect that Agnico could be good leadership and a very important, very large cap gold miner. Royal Gold is important because it's an important royalty company. Similar situation, it's right up near its overhead natural resistance. Its relative strength is above a rising moving average, which is very encouraging. And look at the relative strength of Royal Gold as a royalty company to the gold mining index. It's been leadership since the beginning of 2016. This looks terrific. Okay, and then finally, we have to have a small cap name, one that has the characteristics and the potential to lead the industry group. And this is like sort of a growth theme, one that can be maybe above average performer potentially. And so here's Sandstorm to the S&P. You can see it's above a rising moving average on relative strength. It's just backed up. It's touched it, and now it's pivoting back up again. You can see a pivot occurring in Sandstorm, and it is above its early 2018 highs. This looks very constructive, looks like a completed base. Relative strength to its industry group is rising. It's pulled back, and now it's attempting to turn on a relative strength basis to its peer group. And with that, thanks for being here, and we will see you next time. Take care. So long.